Hello, everybody, and welcome back to the M3 Market Update. My name is Melody Wright, and I do this show to try to give you context about what's going on in the housing and commercial real estate markets as well as mortgage finance. It's been a minute since we've talked. Happy Thanksgiving to all, belated Thanksgiving. I know we're all looking toward Christmas right now, but I hope everyone had a wonderful time. I cooked for 20 out here at the farm. It was a lot of fun, a little exhausting, but I hope everybody's Thanksgiving was as fun as mine. So, welcome back. There's a lot going on, as I say each week, and it almost makes it a bit overwhelming to try to understand what to focus on. I know that, I did a show recently on what's going on with the data breaches at Mr. Cooper, and since Loan Care has also been breached, as well as a large national title company. So, why is this important to what's going on in the housing market? It's important because I think that what's being set out is the idea that the non-banks are not equipped to actually handle mortgage servicing. And what does that mean? It means that potentially all those loans that are in default, that ticking up of default that I've been talking to you about, that those mortgages could go on a foreclosure pause. And so they won't necessarily be coming to the market as distressed homes. So it's important to watch and understand what's going on there. So similar to the way that the VA loans were put on a moratorium for foreclosure until May, making it, sort of politically palatable in terms of, because even in May, then you have to start the engine over again. There's a noticing period. So it will run up right until the election, so that you won't see those material foreclosures. So, I think that the foundation is being set to do that for FHA and probably Fannie and Freddie as well, as we start to see the consumer continue to come under stress. My view is by June, we'll likely see, material delinquencies, certainly not to the peak of what we saw back in the crisis, because guys, we're just getting started. So many people say things like it's not 2008, etc. No, we're just getting started. But that's mortgage. And I think most of you who know me understand that I don't think the biggest fire is in mortgage. I think the biggest fire is going to start in the investor class, where they did these all cash sales, or they did, non-traditional leverage. The DSCR space, which is only about 5% of the overall mortgage market, I absolutely think we're going to see distress there without a doubt. But of course, that wouldn't be enough to move the needle. Where I'm getting really concerned, and one of the reasons that I didn't do a video, is because I've actually been doing some research and interviews with people in a shadowy section of the market called the private note market. And this, I believe, has sprung up because I think all of you guys know I'm a big fan of Eurodollar University. And if you go back to the early shows with Emil Kalinowski and Jeff Schneider, they talk about the fact that, you have to, the market is actually desires, sort of risky lending. It's just kind of the nature of the beast. And I think that what's happened is, as the banks got out of mortgage and then the non-banks got into very heavy government mortgage, meaning 95% of all mortgages are backed in some form either by the GSCs, that's Fannie and Freddie, or FHA, VA, USDA, etc. And so this private market had to spring up somewhere. And this is the private note space. I'm not going to talk a lot about it today, but I'm going to tell you, I will be talking about it in the future as I continue to do some research, because guys, I think this is going to be something that's going to be very surprising to all of us. In addition, I think fraud is going to be a big driver of what I would see as distressed selling that is about to accelerate. So, welcome back, guys. So much going on. I think that, what I would like to talk about just a little bit today before we get into some of the monthly statistics, because this is the week that I do the monthly summary in my Substack, is, the noise around home prices. So, a lot of the indices came out this week showing home prices going up. I think those of you who watch me, I think this is the least interesting information. It's so lagged. The Case Schiller, which is, one of the most reputable surveys, that survey is for repeat sales, and it also works on like a 3-month moving average. And so, in reality, when you're looking at September data from Case Schiller, you're actually looking at July, August, September. And so it's very lagged. Today is November 30th. And so we just got information that is a combination of July, August, September. That's not going to tell you what you need to know. It's certainly not going to tell you about the direction of the housing market. And everyone is going to jump up and down on these. But as we've talked about here, when no one can transact in the market as well, and it's only your top 20% are those with a lot of, extra resources, then those home prices are going to look higher as well. But I can tell you absolutely that 42 of the 75 cities that I track, when you look at month over month home prices per Redfin, they're down. And so in aggregate, Redfin was also up a little bit. But I say often, real estate is local until it's not. And so where I think all of us should be turning our eyes right now is to Florida, because Florida is just rife for speculation and rife with speculation currently. Based on what I saw down there, it's a bit staggering, guys. And there's just a lot of narrative out there. Miami is my favorite subject because no one wants to talk about the negative demographics. No one wants to talk about all the vacancy, etc. No one wants to talk about the fact that they were top 5 in net migration out, according to the United States Postal Service. There's just so much narrative in Florida, but that is where all of this, I believe, will begin. And I'm not just saying that as I'm sticking my finger in the air. It's because I'm tracking these cities. I'm watching what's happening, and I'm watching inventory accelerate as it comes to market. And a lot of that is distressed sales. I tweeted out something yesterday, which was one home that I had visited when I was in Miami, went down to Fort Lauderdale with Kristen from Twitter, and we looked at this home that it was a fix and flip. They'd done some really silly stuff like enclosing the garage, crappy construction. And, they thought they were going to make a pretty penny on it. So I probably went there in early August. And so, they were kind of hoping, but now they're starting reducing that price. They've done a price cut of $80,000. They need to move this because likely, they're coming under stress, not able to pay their property taxes, their insurance. And, in Florida, taxes are due in November. But you get a few months to pay them, but all the servicers pay them in November because that's where you can take advantage of the biggest discount. It's kind of like a discount that it's 4% in November, 3% in December, 2%, etc. as you go down. But the point is that everybody's got their notices, their taxes are due, and the servicers pay in November because by law they have to take advantage of that discount. And so what went out are the escrow notices, and I can tell you people are freaking out. And what is an escrow notice? Essentially, that tells you, hey, I'm your mortgage servicer. I pay your taxes. I pay your insurance. And so what they do is they kind of collect a little bit each month from your paycheck to be able to do that with a scheduled disbursement. Well, what they're doing is they're forecasting the year ahead, and based on those new assessments, etc., they need to take more money from you each month. And so that means that all your payment is going up. And so those notices went out in Florida, and it's causing distress. And you can see it as inventory increases. And so I say often that taxes and insurance are not sexy because they're not sexy, but they're going to drive a lot of this inventory to market. And it will start with the investors/fraudsters. And fraud is going to be a big part of this story this time around. So, all eyes should be on Florida because as last time, that's where the fire is really going to, we had the fires in Phoenix and Austin and some in California, and everybody just kind of wrote that off as, that's those places. Well, Florida is such a huge market. So many people are invested there, including in international investment. Like it truly will kind of be the epicenter, I believe, with Texas taking a close second. But for early indications, especially with what I'm seeing, we will see the distress there first in terms of what I think will happen nationally. So, okay, where to focus is kind of been a bit difficult and a little overwhelming for me because there just is so much going on. I went out to Denver last like a week, 2 weeks ago, I guess. And, again, just another overwhelming experience. Denver was just a big new build site with multifamily, single family residents. And meanwhile, the tech center had, for sale, for lease signs on every single building there. So, as well, Denver has negative demographics. I'm not going to dive deep into Denver this week. I'll do that next week because there's some additional information I want to put together. But just suffice it to say that Denver, just like many of these other cities, Charlotte, Nashville, Austin, Orlando, Jacksonville, etc., they are building like crazy. And they're building in the exurbs, they're building everywhere. You just could hear the hammers. I'll put up some videos next week as well. So a lot going on. Important thing is the path ahead. And I believe the path ahead, if there's no credit event, however, it's feeling very iffy right now with what I'm seeing in various markets. It does feel like, with sort of the banks hoarding liquidity, with various different, not great functioning in the bond markets, that there is stress. There is stress in the system, which could lead to a credit event. We don't know where that might come from. But if there is no credit event or if job losses do not escalate, I still believe this crisis will happen. It will just take longer. And we will see absolutely the true stress of the consumer by, I think, in mortgage at least by June, as well as with some of these investors, fraudsters, as these property taxes come due, etc. So home prices, I would just take that with a grain of salt. What I'm seeing in the real-time data in these cities where you can see the distress first is essentially those home prices will not sustain. So, just take all the narrative with a grain of salt, understand that these indices are very lagged. Also understand that a lot of our data comes from surveys. We know that, survey participation is down. So take it all with a grain of salt. Look out at, read my Substack, look at the data, and, just kind of keep your eyes on the ball because the path ahead, unless there is something that comes our way to enrich, the majority of Americans, not the top 20%, the majority of Americans, the affordability crisis has, hit an inflection point. And I believe that we're about to see a real demand destruction, no matter what rates do. And of course, with rates going down a little bit, the 10-year and the mortgage rates going down because, basically mortgage rates follow that directionally anyway. So I believe that, even with rates going down, we're still going to see distress because these home prices have just reached a level of unaffordability. And I forgot to mention that new home sales were down significantly this week as well. And we saw that median price just plummet. And so a lot of people are talking about that on social media as well. Again, that's just 1 month. I'm not getting super excited about that until I see that that's a trend, because I know overall where we're going to end up because we have just reached a level of affordability. lack of affordability. So, these little monthly pieces of data, they're important. They're telling us, but I don't put all my eggs in one basket. And so it is important to see that price drop, but I'm not getting as excited as some out there because I think we probably still have a little bit of up and down to go. So, all right. Thanks, guys, for joining me this week. This show will be a little different. I typically go over the week, but for this show, I'm going to do some month over month information with just 1 year over year metric. And, I am working behind the scenes to try to put together a little army of volunteers that will help me so that I can improve video quality, put stuff up on the screen. But honestly, I'll get there when I get there. Stay patient with me. But I am working to try and improve the visual display of the content. For now, I will put it in the show notes so that you can try and follow along. So please, look at the show notes as I sort of read through the stats. So there's a lot of movement, and it's hard to really, pinpoint exactly what's going to happen. But this is some information that will help you, especially if you're looking at a specific city that you're interested in. Okay, so top 10 month over month increases in listings for sale. Okay, so this is interesting, but I always mess that up. Brattleboro up 25.93%. Westchester County up 21.77%. Cape May up 13.22%. Carlsbad up 10.97%. Fort Lauderdale up 8.79%. Palm Springs up 8.51%. Pembroke Pines in Florida. This is a community I visited in Florida. That's up 7.22%. Fort Myers in Florida up 7.21%. Scottsdale up 7%, and Phoenix up 6.72%. So quite an interesting mix in the top 10 of month over month increases in listings for sale. A lot of Florida in there, as I'm saying, but also you have some interesting Northeast cities. I often hear from people that, things are still flying off the shelves or like hotcakes in the Northeast. That's based on the data, that's actually not true. I think that there's still a lot of narrative out there, but it's slowing down everywhere. So I would encourage people, if you hear that from someone, validate it. How can you validate it? Well, you can actually, Redfin's not a bad source. I think you guys know I say never use one source, but Redfin will show you in the market insights the month over month and year over year changes. So, you for the month over month, you have to track them manually yourself or get a paid report from them. But the year over year, they show you in the market insights. So that'll help you understand what's going in your local market and not what's coming from someone's, narrative who is hoping to, make some money off what they're saying to you, and that's the realtors, etc. So, okay, top 10 month over month increases. Not month over month, sorry. Top 10, this is our top 10 from January. That's when I started tracking. The very interesting new entrant here in the top 10 increases in listings for sale. So we have San Ramon at 107% increase since January, Bakersfield at 82%, San Francisco at 79%. Now this is lower than San Francisco has been. It's very interesting, but they have increased their listings for rent as well. So I wonder if people are deciding, hey, I can't actually sell it. I'm going to list it for rent. And that's what I'm getting. I'm working on ways to sort of show that visually. I'm hoping the volunteers will help, so bear with me on that. Okay, then Denver at 56.36%, and this is so not surprising, and this is just going to get worse based on what I just saw. Coeur d'Alene at 54.66%, Seattle 47.5%, Galveston, Texas 46%, and Dallas 45%. And these are increases in listings for sale since January. San Jose at 43%. And then this is weird, guys, Knoxville at 43%. This is the first time Knoxville has made it into the top 10 for listings for sale. And very, very, very interesting. Tennessee has been sort of the holdout. People definitely still recommending people to come to Tennessee. So to see this inventory starting to build is very interesting. So we'll keep watching. Okay, so top 10 month over month increase in listings for rent. Okay, Sevierville, 59%. Guys, Sevierville, yeah, so it is just a hotbed of short-term rentals. So many short-term rentals, over 7,000 in this tiny little area. So to see listings for rent, long-term rental, not short-term rental increase is very interesting. So we're going to keep our eyes on this. Now, this next one I think might be a data issue. So we will have to watch it, but I checked it 3 times. Dallas coming in at 55% increase in listings for rent. This sometimes happens on realtor.com, and I don't know why. We'll just keep watching it. It seems to be almost like a correction sometimes. Like maybe they get somebody new reporting. I'm not exactly sure. So we'll watch this. Brattleboro up 33%. Knoxville, again, for listings for rent, up at 25%. So listings for sale up, listings for rent up. This is telling you there might be some trouble brewing there. Sedona, 25% increase. San Francisco, 24%. So, we have it kind of reducing or becoming less stress in listings for sale, but is that because they've given up and now they're listing them for rent? This is what we will continue to watch. Costa Mesa at 20.55%. Houston at 18.83%. Coeur d'Alene at 12.3%. And Fort Myers at 8.36%. So we've also got Fort Myers and the increases in listings for sale as well as listings for rent. Okay, what does that tell you? There's trouble in Fort Myers. When I drove through Fort Myers, there were a lot of for sale signs on beachfront property, which, that's counter the narrative. Everybody's always out there saying, oh, somebody's going to come in, the institutionals are going to come in, somebody's going to swoop up that property. But even for beachfront property, it's not selling, could still be part of the buyer-seller strike. And honestly, though, if you're a smart investor and you're looking at these increases in property taxes and insurance, and then the cost to rebuild in Fort Myers, because you're going to have to rebuild to a completely different specification to withstand, a hurricane such as Ian, they're maybe thinking this doesn't make sense anymore. And so, guys, when demand falls, and we're seeing demand fall due to affordability, investors are not going to throw bad money in just to get some beachfront property. They're going to wait until it's selling for pennies, but there could be cases it doesn't sell at all. If you look back during the Great Depression and you look back at the Golden Isles, a lot of mansions people never thought would, go unsold did, and they've disappeared now. So, this could potentially end up being a very distressed time period. I'm not saying in the next year, this is more in the next several years, but these are the types of things we have to watch, and we can't sort of get addicted or kind of, blinded by our own bias. We have to really, look at it from all angles. And, what I do is I read a lot of historical stuff, as well as, I go out on the road, as well as I track the data. And so, 2 books I would highly recommend on Florida if you're invested there, or you're thinking of investing there, or you're thinking of moving there, is Bubble in the Sun and Swamp Peddlers. And what those 2 books will tell you is that what's happening has happened before and may actually happen again. So check those out. Okay, so listings for rent, those were the increases. Now I want to talk to you about the sort of the highest, sort of occupancy or vacancy rates in some of these markets from a multifamily perspective. And so, average occupancy for October in multifamily, according to Real Pages, was 94.3%. And so these are the top 10 cities with much lower occupancy to the average. Okay, so Houston at 90.2%, compared to the average of 94.30%. So that's 4.35% below the average of occupancy. Nashville at 90.4%, Dallas at 90.7%, Chicago at 90.8%, Phoenix at 90.8%, Austin at 91.2%, San Antonio at 91.4%, Augusta at 91.9%, Atlanta at 92.3%, and Las Vegas at 92.6%. So these are all cities underneath or below the average occupancy for multifamily. And now, what many of you know about those cities, if you read my Substack, is that they've got a lot more multifamily on its way, as well as the built for rent. I just realized, with the help of a colleague as well, where we are going to be able to get some of the built for rent numbers from the census. It's not going to be everything, but it's going to start to give us a directional number. I'm super excited about that. Okay, so next thing to talk about is the top 10 month over month decrease in short-term rental listings. And so, by the way, guys, we didn't have a top 10 last time. There weren't 10. But we're actually getting some decreases in short-term rental listings in certain cities. Now, but I want to caution you, because a lot of the cities are actually increasing listings as well, which is just so crazy to me in these oversaturated markets like Austin, where you have over almost 15,000 short-term rentals. We actually saw an increase month over month. That's just insanity to me, especially now that Airbnb has rolled out that guest favorite, which is going to really, and that's where, based on them kind of going through your reviews, which are the guest favorite. And so can you even imagine your listing is never going to make it to the top, especially if you're a new entrant. It's just crazy what Airbnb is doing. But there were some cities with some decreases in listings, so let's go over those. So essentially, New York was down 6.13% month over month. Coeur d'Alene down 5.07% month over month. Cape May down 3.97% month over month. Portsmouth down, and Portsmouth is in New Hampshire, is down 3.74%. Rosemary Beach down 2%. Brattleboro down 1.5%. Galveston down 1.28%. Bakersville down 1%. San Jose down 0.28%, and Augusta down 0.46%. Now, again, I think we had 3 last month that were down month over month. New York, we know, is because of the new regulations there. But, that's, if you are a short-term rental operator, you need to be paying attention to the regulatory headwinds in your cities, because they're coming, guys, and it's an election season, and everyone is this is a hot button issue, from both hey, I don't want a party in my neighborhood, to also, I need affordable housing. So it's going to be a hot button issue. There's nothing that makes people more mad than, sort of things they don't like around where they live, and politicians are going to jump all over this, as well as the hotels are already lobbying to, for these regulations for short-term rentals to be taxed like hotels, et cetera, to be zoned. And so there's a lot of noise happening here in the short-term rental space. I'm not saying that market will go away, but it's definitely about to change, and there's going to be, a lot of folks that aren't going to be able to make it because the assumptions that they had in terms of what that cash flow would be, also they weren't aware, or essentially this regulation didn't exist. So there's a lot to be watching in these markets. Okay. Now, top 10 year-over-year decrease in short-term average daily rate. Now, I did year over year for this instead of month over month for this show, just because, I think month over month is important, but you have to think about the seasonality for these places. Football season is going to make certain areas hopping, and then the next month that'll go away. So, but year over year, top 10 decrease in short term average daily rate, the rate that you can charge. So, Palm Springs down 12.65%. That's kind of a big deal, guys. That's a very popular destination. El Cajon down 10.6%, Destin down 8.29%, Nashville down 8.18%, Cleveland down 7.88%, Coeur d'Alene down 7.08%, West Palm Beach down 5.78%. West Palm Beach, that's not good for those guys. And Nashville as well here is really not good. And just quick side note, I have a colleague. I'm hoping I can convince him to do a deep dive on Nashville, and he was doing a scrape of MLS data, and so of all the ones that were listed for sale, the majority had some sort of reference to short-term rental. Now, this would be a complete, sort of validation of what we all, or many of us, believe would happen, is that essentially, because of the oversaturation of Airbnbs, that these would find their ways to the MLS to listings for sale. So look out for that. I'm hoping to convince him. And if not, at least he'll share the data with me, and I'll put that in the Substack or discuss it here. Okay, so Ventura County down 5.61%, Detroit down 5.2%. That's kind of funny. And then Richmond down 5%. Okay, so top 10, I don't think I've talked about this in YouTube, but it's something I'll, start tracking from here and talk more about because it's going to be more relevant. But essentially the top 10 month over month increase in foreclosures, okay? So some interesting names on here. Tucson at 24.23%, Costa Mesa at 20%. Costa Mesa? Okay. Denver at 18% increase month over month. Palm Springs, now that's also interesting, right? They're sort of up there for that decrease in biggest decrease in short-term rental pricing, average daily rate, and now kind of a very significant increase in foreclosure. Fascinating. Detroit also makes its way here. 16.38% increase month over month in foreclosure listings. Johnson City, where I am, this is also very interesting because, guys, everybody thinks, okay, it's Phoenix, it's Austin. No, I believe you're going to find pockets of this in every city, every major city. It's like I saw in Pittsburgh is very similar to what I see here in Johnson City. It's not like Denver where the entire city is a new build site, but you have all these pockets of these new home builds. There's one, I'm actually going to do a how it started, how it's going with the first new build subdivision I ever toured was actually here at Christmas in Johnson City, Tennessee last year. And guys, it was completely empty then. And now there's one house, I believe, that's occupied, maybe a couple more. I've just been looking at it from the road, but I'm going to go into the subdivision and take more pictures. But there's just these pockets of new build sites, and they're all over they're just in random places all over this area. And there's, 30 to 40 homes listed at 500 and above. Guys, the median income here is about 48,000, if that. I'll have to go check that for sure, but it's very low. And these things, you'll see one of them on MLS. There's 30 there. So they're not even all on the MLS. They will never sell here for those prices. That's just not going to happen. Not going to happen. And so, but it takes time for realization. And so seeing Johnson City up here is very interesting indeed. And I think that's likely because these could be developers, et cetera, that can't sustain these homes anymore. So Oceanside down at 12.99%. Not down, sorry, increase of foreclosures, 12.99%. Encinitas, 12.5%. Portland, and this is Portland, Oregon, at 11.59%, and then Newport Beach at 10.71%. So what I find very fascinating here is, kind of California and the idea that, these very wealthy areas, have been saying to me, places like Oceanside, it's still very competitive, days on market are down, but you are still seeing distress. I know particularly, I talked to a realtor out there on one big Oceanside property. They were just finishing, they were hoping to sell these things for 1.5 million. They're not able to. So you had a lot of people take on leverage, start projects. A lot of them were realtors too, which I have some problems with. But essentially, they took them on, took out the leverage, the construction loans, and these things aren't selling. And so, it could very well be that these realtors slash investors just they're going to walk away, and that's what we'll always see. Investors will walk away at a much higher rate than your regular borrowers, and this is also what the Philly Fed papers talk a lot about. So I just think this is actually going to escalate. Okay, guys, I know I've been away. There's just so much happening. I'm trying my best to keep up, trying to figure out, where to focus, because it seems like, one week there's a fire in one area, another week there's another, and then there's a deep dive study I need to do on things like private notes. So, bear with me as I try to give you the most rounded view of what's going on out there and keep you up to date. And as I said, I still really don't know much about the way YouTube works for some of this stuff, but I'll be posting on the channel just various videos that I'm doing. So if for some reason a video is delayed, you'll be able to see, the latest in some of those videos. So be watching out for those as well. As always, you can reach out to me on Twitter, at me on Twitter. If I'm not following you, you can just at me with a question and I will follow up with you. And you can reach me there at m3_melody, MELODY. My Substack is where, you don't have to just listen to me rattle stuff off. You can go in and that's where I'll put all of these metrics, etc., for you to track each week. And then, of course, LinkedIn, Melody Wright. And so Substack, by the way, M3 Melody Substack. And then, of course, here on YouTube. So thanks, guys, for joining me. I hope you did have a wonderful holiday weekend. I think we are at an inflection point, and this is where it's going to be very important to pay attention. And for many of you out there that have been waiting, I do think things are starting to break loose. I do think that, we will see the corrections start to happen. But these things take time. If we don't have an accelerating event like a credit event or increase in, unemployment, this could take a bit longer. My base case is we don't see the biggest declines next year. We see them in 25. But I'm starting to get the feeling that things are going to happen faster based on what's going on out there in the markets. And I would also warn everyone, the stock market is not where you should be getting your direction of where things are going. There's a lot of mania still out there. We're running up to the end of the year, and people are going to do whatever they can to juice those bonuses. And so the stock market is not a good indicator of what's going on in the housing market, in the economy as well. I would look to things like the consumer sentiment, which is, it's been really low. And I think that something kind of broke in October with the consumer, and it's yet to really show itself. We get confusing data like, highest online sales ever. But then you hear, well, retail sales like in the stores were down. Guys, people are going to spend at Christmas. I grew up poor, and I can tell you, we always spend at Christmas, but it's just sort of the last bit of runway, I honestly believe, unless, of course, the UFOs land and give us all a lot of money, or, our government decides to give more fiscal stimulus because of some type of event to make it through the election year. A lot can happen. but we're going to keep watching the data and, keep watching what the path ahead looks like. And that's what we'll talk about here, hopefully each week. So thanks again, guys, for joining. I appreciate it. And I'll talk to you soon. Have a great week. Thank you.